Okay, let's dive right into this explainer. We're going to demystify all that financial jargon and see exactly how a business tracks its money. I mean, whether you're launching a tiny startup or analyzing some massive corporation, the main objective is always the same, right? To earn a profit. But how do you actually know if you're winning? How do you track a single dollar from just a random daily transaction all the way up to the final grand scorecard at the end of the year? Well, today, we're going to master the rules of the game by walking through the entire accounting cycle together. Now, a super common misconception is using the terms bookkeeping and accounting interchangeably. But honestly, they represent two completely different phases of the game. Bookkeeping is basically the foundation. It's the daily grunt work, identifying transactions, measuring them in terms of money, and then diligently recording and classifying them. Accounting, on the other hand, that takes all that raw data and elevates it. It's the high-level art of summarizing, analyzing, interpreting, and then communicating that financial info so you can actually make real, strategic decisions. To keep our cognitive load light, here's our roadmap. 1. The language of business. 2. The accounting equation. 3. GAAP, the rules of the game. 4. The accounting cycle begins. 5. Ledgers and trial balances. And 6. The final financial statements. Let's get into it. Section 1. The language of business, foundational vocabulary. First up is capital. Capital is literally just the initial seed money or the value an owner pumps into their business to get it off the ground. Like if you start a lemonade stand and put in $100 from your own savings to buy lemons and sugar, that $100, that's your capital. In the corporate world, you'll hear this referred to as owner's equity or net worth. Basically, it's your skin in the game. Next, we've got liabilities. Liabilities are your debts, your obligations. It's the amount the firm legally owes. And what's kind of fascinating is that this is broken down into two types, internal and external. Internal liabilities are what the business itself owes back to the owners, because legally the business and the owner are two totally distinct entities. External liabilities, that's what you owe to outside creditors, like a bank loan or unpaid wages to your staff. And a distinct separation between the business and the owner brings us right to drawings. It is absolutely crucial to remember that a business has its own distinct financial identity. So if an owner takes cash or inventory out of the business for their own private use, say taking $100 out of the register to buy a personal video game, that gets classified as a drawing. It tracks the value leaving the business and going back to the owner.
Section 2. The accounting equation, the supreme law.
Here's the thing. Every single business transaction on Earth, whether you're buying a stapler or acquiring a billion-dollar tech company, is governed by one unbreakable mathematical law. Everything must balance. A change in one area literally forces a change in another just to maintain that perfect equilibrium. And that brings us to the core accounting equation. Assets will always equal your liabilities plus your capital. So your assets, which is the total value of everything the business owns, must perfectly match the sum of what you owe to outsiders, your liabilities, plus what you owe to the owners, your capital. Let's anchor this in reality with Kapil's shoe business. Kapil invested 80 lakhs of his own money, right? So that's his capital. He also borrowed 20 lakhs from a friend named Sunil. That's his liability. You add those up and the right side of the equation equals 100 lakhs. Now look at the left side, his assets. With that 100 lakhs, he bought a shop for 40, furniture for 10, stock for 25, kept 20 in cash, and has 5 in debtors. Add those up, exactly 100 lakhs. The two sides perfectly balance out. If he buys more shoes with cash, his cash asset goes down, his stock asset goes up, and that 100 lakhs total, it never changes. That is the magic of the equation.
Section 3. GAAP, rules of the game. So, before we start recording daily shoe sales, we need to understand GAAP. Generally accepted accounting principles. Think of GAAP as the referee. These principles ensure everyone records their financial history using the exact same standardized assumptions. Take the going concern concept, for example. It assumes the business will operate indefinitely, so you don't value your assets based on some fire sale liquidation happening tomorrow. Or the historical cost concept. That dictates you record an asset at the exact price you paid for it, instead of constantly tweaking it based on what you think the market value might be today. It creates complete objectivity.
For instance, look at how the accrual and matching concepts play out in the real world. These dictate that we record transactions when they occur, not just when cash changes hands. If a business uses electricity in March, it records the utility bill expense in March because the service was already used, even if the actual cash payment to the power company won't happen until April. You always match the expense to the period it actually helped generate revenue.
Section 4. The accounting cycle begins. The play-by-play.
Now that we know the rules, let's step onto the field and look at the cycle in motion. This is a mandatory 5-step process that repeats every single period. It literally transforms the raw chaos of daily business into perfectly organized data. We start with 1. Transactions, 2. Journal entries, 3. General ledger, 4. Trial balance, and 5. Financial statements. Let's zoom in on step 2 with a simple journal entry. This is the very first place a transaction gets officially recorded. Notice how structured it is. We have a DR for debit on the top line, say representing furniture coming in, and an offsetting credit on the bottom line for the cash going out. The $16,000 amount in the debit column must perfectly align and balance with the $16,000 in the credit column, no exceptions. But what happens when things get complex? Sometimes, a business event affects more than just 2 simple accounts. Like if you purchase furniture on credit, or you're handling salaries and rent at the exact same time. That requires what we call a compound entry. It just means we might have multiple debits or multiple credits. But guess what? The golden rule still applies. The total sum of the debit column must still perfectly equal the total sum of the credit column.
Section 5. Ledgers and Trial Balances. Organizing the Chaos.
Okay, so where does a transaction go after the journal? Well, a journal is basically a massive chronological diary. If you want to know how much cash you have left, reading a diary entry from 300 days ago isn't going to help you much. So we post these entries into specific ledger accounts. We take every single cash transaction and group them all together in a cash ledger. We take all the furniture transactions and group them in a furniture ledger. Then we add up the 2 sides of each ledger and find the difference to get our final balance. It's literally the ultimate sorting mechanism.
Section 6. The Final Financial Statements, the Ultimate Scorecard.
Finally, we zoom out to the last step, the financial statements. These come in a few flavors. First, there's the trading account. This one is hyper-focused on core production costs. We tally up direct manufacturing expenses, like raw materials, freight, factory rent, and the wages of the workers actually making the product. By comparing these direct costs against our sales, we find our raw gross profit. It basically answers the question, are we actually making money on the core thing we produce? And that brings us right back to our ultimate scorecard, the balance sheet. This proves if the business actually survived the year. After 12 months of complex operations, thousands of journal entries, and ledger postings, the golden rule proves itself all over again. Look at Kapil's final totals. His assets are exactly $100,000, and his liabilities plus capital perfectly equal $100,000. It's a total mathematical triumph showing complete accountability. We've seen how meticulously structured this whole system is. But while the accrual method is the absolute GAAP standard, ensuring expenses match revenues perfectly, it kind of has a blind spot. It doesn't give you a quick appraisal of the actual cash in your bank. You might show a massive profit on paper because you recorded a huge sale, but if the client hasn't paid you yet, your bank account is still empty. So I'll leave you with this final thought. How might recording revenue before you actually have the cash in hand change the way you view your own financial success? And how do you make sure you don't confuse accounting profit with the actual cash you need to survive? Keep learning, and I'll catch you in the next explainer.